You are staring at your phone screen at 1 in the morning, scrolling through real estate listings that feel like a fever dream. You find a house for $700,000 that the agent has labeled a charming starter home. But the photos tell a different story. The kitchen has cabinets from the late 90s, the carpet looks tired, and the backyard is roughly the size of a postage stamp. You start doing the mental math against your own salary and feel a cold knot of anxiety in your stomach, wondering if you somehow slept through a decade of economic growth or if the entire world has simply lost its mind. It is not just you, it is the math. And in 2026, the math has become a financial survival game that most people are losing. Today, we are going to do the calculation that mortgage brokers and agents want to avoid. Who can actually afford a $700,000 house without turning their life into a permanent stress simulator? There is a massive, dangerous gap between what a bank will approve you for and what will actually allow you to sleep at night. In dozens of American markets right now, $700,000 is no longer the price of a luxury estate. It is the entry fee for a standard 3-bedroom box in a decent school district. The median household income in the United States is currently around $84,000, which means we are asking families to buy homes that cost more than 8 times what they earn in a year. If that ratio sounds like a mathematical impossibility to you, it is because you are actually paying attention. Every voice in the system is telling you to just jump in. The brokers say you are approved, your parents talk about how they bought their first home on a single income, and influencers tell you to stretch now because prices only go up. But the system is built to get you to sign the papers, not to ensure you can actually afford to live a life once the keys are in your hand. The first wall you hit is the down payment, which is where most dreams of home ownership go to die in 2026. The traditional recommendation of 20% down on a $700,000 home is $140,000 in cash. When the median savings account in America holds only about $8,000, you aren't just a little short, you are facing a gap that would take over a decade to close even if you were a world-class saver. If you earn that $84,000 median income and somehow save 10% of every gross dollar, which almost nobody actually manages, it would take you over 16 years to scrape together that down payment. By that time, the house will likely cost $1 million and you will be right back where you started. So, most people do what the system encourages. They put down 5 or 10% instead. But this choice unlocks a hidden recurring expense called private mortgage insurance, or PMI. This is essentially a poverty tax you pay every month because you weren't wealthy enough to have the full 20%. It runs between $300 and $500 a month for a loan of this size, and it provides zero protection for you. It only protects the bank in case you default. You are being financially punished for the crime of trying to buy a home without being rich. Now we look at the actual monthly mortgage payment. If you somehow scrape together 10%, which is $70,000, you are left with a $630,000 loan. At current interest rates hovering between 6 and 7%, your monthly principal and interest payment is going to land around $4,100. But that is just the beginning of the bill. You have to add property taxes, which can easily run another $700 to $900 a month depending on your zip code. Then there is homeowners insurance, which has skyrocketed due to climate risks, adding another $350 to your monthly total. Then there is maintenance, the silent wealth killer that everyone forgets until the HVAC dies in the middle of a heat wave. The standard rule is to budget 1% of the home's value every year for repairs. On a $700,000 house, that is $7,000 a year, or nearly $600 every single month. When you add up the mortgage, the taxes, the insurance, the maintenance, and that PMI tax, your total monthly housing cost is sitting at roughly $6,400. And that assumes nothing major breaks, and your local neighborhood association doesn't hit you with a surprise assessment for $3,000. Traditional financial advice says you shouldn't spend more than 28% of your gross income on housing. If you are spending $6,400 a month, you need to be earning roughly $274,000 a year to follow that rule. Even if you use the much riskier 43% debt-to-income limit that banks use for approvals, you still need to be pulling in nearly $180,000 annually. The punchline of the 2026 housing market is that only a tiny fraction of American households earn that kind of money. This means that for about 80% of the country, a $700,000 home is not just a stretch, it is a mathematical fantasy. Let's look at a real-world example of a household we will call the Millers. They are a dual-income couple, earning a combined $210,000 a year. They are solidly in the upper middle class and feel like they should be able to afford a nice home. Their gross income sounds massive until the tax man takes his cut. After federal and state taxes, healthcare premiums, and a modest contribution to their retirement, they are taking home about $12,500 a month. If they buy that $700,000 house, over half of their take-home pay is gone before they even buy a loaf of bread. Once they pay the $6,400 housing bill, they have about $6,000 left for everything else. They have 2 car payments because they both work, which eats $800. Car insurance and gas take another $500. They both have student loans from the degrees they needed to get these high-paying jobs, which cost them $700 a month. Groceries for their family cost $1,000 if they are being careful, and utilities for a larger home add another $500. They are left with about $2,500 for clothing, medical copays, kids' activities, and the occasional need to leave the house so they don't lose their minds. Their savings rate for emergencies or retirement outside of their basic work plan is effectively zero. This is what being house poor feels like in 2026. It feels like having a $200,000 income but still checking your bank balance before you buy groceries. It feels like lying awake at night doing mental gymnastics about whether you can afford new tires this month, or if you have to pray, it doesn't rain until next payday. You own a house, technically, but the bank really owns your life for the next 30 years. You become a prisoner in your own home, working a job you might hate, because you cannot afford even a single week of income disruption. Every unexpected expense becomes a full-blown crisis because you have zero margin in your budget. The system is designed to ignore this misery. Real estate agents want their commission, banks want their 30 years of interest, and the market wants to keep comparable prices high. Nobody in the transaction has an incentive to tell you that you are about to drown yourself financially. We have normalized this desperation and rebranded it as a rite of passage for adults. We tell ourselves that eating ramen and skipping vacations is just part of building equity, but you cannot eat equity, and you cannot use it to pay for a transmission repair. The harsh truth is that for the vast majority of people, the American dream has been warped into something unrecognizable and potentially ruinous. Home prices have increased by 400% since the 90s, while incomes have only grown by less than half that amount. The math is structurally broken. You cannot budget your way out of a housing crisis, and you cannot side hustle your way into a down payment when your rent already eats 40% of your check. Real wealth is not found in a house you can barely afford. It is found in the margin of your budget. It is the ability to invest consistently, to handle a medical bill without a credit card, and to sleep at night without an anvil of debt hanging over your head. Real wealth is freedom, not equity that you can't touch because you are trapped by the asset itself. If the math for a $700,000 house doesn't work for you right now, you have to give yourself permission to walk away. There is no trophy for being house poor and no prize for owning a kitchen you are too stressed to enjoy. Stop looking at what the bank says you qualify for and start looking at what your life can actually sustain. Find the number where you can pay the mortgage, fix the roof, and still remember what it feels like to not be terrified of your mailbox. For most people, that number is nowhere near $700,000, and that is perfectly okay. You are not failing at adulthood. The system is failing you. The smartest move you can make in 2026 is recognizing when a game is rigged and choosing not to play it. Your financial stability and your mental health are worth more than any piece of real estate. Trust the math, protect your margin, and refuse to become a statistic in a housing market that has lost its way.